Statement of cash flow. The statement of cash flow is probably the simplest of the financial statement to understand, as is simple a summary of the amounts paid and received in cash over a period of time, more like bank statement. The basic structure of the statement of cash flow is categorization of operating, investing, and financing activities. The bottom line of the statement of cash flow is organization closing cash balance. Just a bank statement ends with the closing account balance. Investment flows, cash flows arise when long-term assets are bought or sold. Purchase of land, building, or equipment constitute instant investment cash flows. Therefore, a negative investment cash flow implies a growth in the operating capacity of the business. Financing cash flows arise when an organization deals with long-term profiles of finance. For examples, when cash is received from an issue of new shares, or when cash is paid to repay a bank loan, as with a cash flow investing, low flow sign can be interpreted unambiguously. 2. Profit and loss report. The income statement has a very simple purpose, which is to record whether an organization has made a profit or loss. The concept of making a profit is very easy. The concept of taking advantage is very easy, meaning that the income generated by an organization exceeds the cost incurred by the organization. Similarly, of course, is if expenses are greater than revenues, the organization loses out. In general, revenue minus expense equal profit on loss or loss. Profit is made over a period of time. Revenue is the value of service rendered and or goods sold during a certain period of time. In this volume of output achieved, multiplied the price charge. Cost of goods sold consists of costs directly attributable to units of output. Gross profit is a subtotal on the income statement, equal to revenue minus cost of goods sold. The gross profit from making sale is the benefit to be amount he earns on the revenues less the related cost of goods sold that he has incurred. The concept of gross profit is sometimes expressed as a percentage of the gross margin. Operating profit is measure of the profit achieved and in selling or making an item. Interest expense is the cost of borrowing money from the bank. Profit before tax is surplus of operating profit over interest expense. Tax in its simplest form is calculated of a percentage of profit before tax. Profit after tax is the amount made by the owner of the business during the reporting period because it's equal to the total value of the output of the business minus the total cost incurred to produce that output. 3. Financial balance. The basic structure of the balance sheet consists of assets, liabilities, and equity. Assets are items of value that are owned by a business. Liabilities are business obligation to make payments to third parties. The excess of assets in a business over its liabilities is called equity. Its owner shares the business, sometimes referred to as shareholder funds. The balance sheets are always prepared for the beginning and end of the reporting period covered by the income statement. These are referred to as opening and closing balance, respectively. Assets on the balance sheet are divided into two categories: fixed and current. Fixed assets are assets that represent business infrastructure. They are held for the long term. They are employed in the business to generate revenue over several reporting periods.